It's mixed. It's a mixed backdrop, to be honest. We've shifted towards a more stagflationary environment over the course of the last few months. That's difficult for asset allocators in general. It's difficult for equities, and it's difficult for bonds. At the moment, the equity market is winning out, but as bond yields continue to go higher, the concern ultimately starts to shift to the growth implications of this central bank tightening. So I think what it means for equity markets is you need to run a relatively defensive portfolio. We've been recommending a sort of a stagflation playbook of commodities and defensives. I think that makes sense in this environment of higher bond yields, and we're watching how quickly the curve, or how deep the curve inverts, and also what the bond market is pricing in terms of potential Fed rate cuts in 2024.
Graham, I take your point about running a playbook around stagflation. A lot of the fund managers have been doing that so far. But what about the playbook around a recession? Because as we talk about yield curve inversion, that could potentially be flagging a recession. Is there a point at which we get to very quickly where that is the playbook for a lot of equity managers?
So if you look historically, when the yield curve inverts, it can invert between 1 and 2 years ahead of an actual recession. Now, of course, things can accelerate and fast forward at this point. I think the trigger is actually going to be the growth data at this point. People are going to try and assume that the bond market, maybe there's some funny quirks in it, etc. They're not going to jump from yield curve inversion today to recession tomorrow. What starts to tip the balance, though, is if we started to see some of the economic sort of leading indicators really start to decline. Now, at the moment, what we're seeing is the PMIs, whether that's in Europe or the US, holding up really quite well. But consumer confidence in both regions is now very low in a historical context. So it's going to remain to be seen whether or not it's the concerns that the consumer has that wins out, and whether we then start to see a fall away in some of these sort of business indicators, or whether actually the PMIs and the ISMs hold up and over time consumer confidence stabilizes and then starts to improve again.
Graham, very good morning to you. You've been doing this long enough to spot a value trap when you see one. Despite you being overweight European equities, I get the sense you fear that there is a value trap in these European equities. They have very low, undemanding forward multiples for the next 12 months. But I get the impression you're worried about those multiples.
Yes, I think, well, we're worried about the multiples look okay, but they don't look particularly cheap. They're basically in line with their very long run average. And given the tricky environment we see at the moment, coupled with a Fed that is raising rates, it's hard to see multiples going up. If global interest rates go up, global equity valuations go down. So the best we can hope for, I think, is the multiples are flat, or they go down if the news flow deteriorates. What we're also focusing in on right now is a potential earnings hit. We came into this year expecting 10% earnings growth, but given the shift in the outlook for Europe over the course of the last month or so, we've had to cut that. We cut that last week to 3%. So you've now, and we're just starting a period where earnings revisions have moved negative. So I think you have some growth concerns playing out, and that's potentially around the top line, but I think particularly around corporate margins. There's a lot of cost pressures in the systems for companies. There's going to be more question marks about whether pricing power will be good enough to allow companies to put their prices up, given some of these building pressures on the consumer from high inflation in general.